This Week in Economics from WBRN Radio and the Bostonred Network. Numbers man here. This is on the 17th of October 2017. A little later than we normally are. We normally do this broadcast on Saturday night or Sunday morning, but a little late, but nonetheless, we're here on the 20th of October. Will be the 30th anniversary of the 1987 crash. It was known as Black Friday. We'll talk about it and the various machinations surrounding it. From the latest from Janet Yellen. Dr. Yellen is the head of the Federal Reserve. She was speaking at a conference in Washington, and her reflections on the economy, International Bankers Seminar. She acknowledged that persistent low inflation this year, undesirably low inflation, has been a surprise, but she expects inflation to pick up as the effects of temporary factors such as falling prices for mobile phones to consumers. The statement suggests that the central bank, of course, they have a meeting coming up, I think 2 meetings, and there will be an interest rate hike, probably 25 basis points. This is quoting her directly here. The next rate hike, the third this year, is coming in December. Economic activity in the U.S. has been growing. We'll have a report, incidentally, from the University of Michigan, Dr. Curtin there. They finally got it back, and it's no longer the University of Michigan. I believe Reuters, it's the University of Michigan, where it should be. As the economic activity in the U.S. has been growing modestly so far this year, and the labor market has continued to strengthen. She said in her speech there were representatives, incidentally, there from the European Central Bank, China, and Japan. Of the hurricane that struck Texas, Florida, and Puerto Rico and the Caribbean. She noted that they caused enormous damage, but she added that the effects of the hurricane on the U.S. economy, now the U.S. economy is a vast economy, are quite noticeable in the short term. History suggests that long-term effects will be modest, and that the aggregate economic activity will recover quickly. Possibly so. A lot of that will be region Pacific. What we mean by that is in certain parts of Texas and in certain parts of Florida it will be a little slower. Now, as far as Puerto Rico, still over 50% of the island is in darkness. Inner structure there would be on the par with a fourth world, third world operation. The power company there had been into financial difficulties. There will be a need for massive amounts of aid to Puerto Rico, no doubt about it. And the present administration has sent some paltry sums there, but not the type of sums that they have. Also, it shows a weakness in the federal relief program, or relief agency, I should say, known as FEMA. They were not off to the races. Modifications had to be made, such as the Jones Act. What the Jones Act is a territory, which is Puerto Rico. The people there are U.S. citizens, but they don't vote. Thus, shipping to them has to be done by what they term U.S. flagships, U.S. merchant marines. but since it is an island and where it is located, that had to be waived so they could get the aid there. Also, there were not enough personnel there, medical, otherwise. Finally, they were able to get some medical ships from the U.S. Navy station there so they could airlift people out. They got in more and more helicopters, etc. And some power workers. Now, Tesla has a solution for them in terms of solar power. We hadn't heard any more about it. They were talking about it. Mr. Elon Musk. And evidently he has these systems in place in some islands that he happens to own. And that could be because Puerto Rico is a vast country when you leave the metropolis of San Juan, etc. And the medical industries there, which is basically their biggest industry, the various pharmaceuticals known as Big Pharma, want to get back to work. Their facilities were not damaged that much, but they will need some work to be back there. So these are part of it. She said that the economy's growth, as measured by the gross domestic product, might be slowed slightly in July to September quarter as the consequences of the hurricane come out. We saw that in a jobs report where it was at minus 30,000 jobs created. This speech followed the central bank's decision at its last meeting to leave the benchmark rate at 1 to 1.25. At the same time, the Fed announced it would be paring down its portfolio of bonds. That's the quantitative easing during the 2008 depression. She declined to speculate, but the Fed's staff has described the stock prices as elevated. At the same time, she said the market levels should be viewed in the context of a banking system that she called dramatically improved in the sense of depression again. Now, a question, and this has been asked by many people. The market, some see as overvalued, potentially higher budget deficits result of DJ Trump's tax program. That will happen, and those things tend to hamper future growth in terms of orthodox economics and what is seen on the markets. So what we're looking at least here at Cranston Analytics, that the market, the market will sort of limp along, and we'll get to that in a minute. And you'll see some ups and some downs in the market part of the scenario. But as far as the economy, consumer confidence is up, and Dr. Yellen went on to say that perhaps there's anecdotal information that consumers see the possibility of a tax cut. Now that is a very debatable situation as to what will happen with the tax cut, how it will pan out. Now the proposal, at least on the corporate level, is to move the corporate tax rate down to 20%. The Oracle of Omaha, one Warren Buffett, says it's not necessary, and it is not. Corporations have a lot of deductions there that they can use. Now, as far as it resulting in up to a $4,000 windfall for workers, very debatable there, period. That perhaps it would be as little as a 10% situation there. So these things tend to work themselves out. One reason we are highlighting the 1987 fall. And that fall, I remember it clearly, almost when the market went down some 32 points. We'll get to that in a minute, but it could have literally turned into a depression. It was the Reagan administration was very lucky at that particular situation. It did improve, but people lost millions of dollars there, and it went into, and we'll get to that, it went into the equity market. particularly in the options part of it, which today now one has to understand the analytics are much better out there than what you had 30 years ago, definitely. So there is a different situation and much more a global economy. Let me just finish this up. I didn't want to get too far off here. This is summed up. This is incidentally from the Associated Press. The future, of course, of Dr. Yellen is up. Her 4-year term ends in February, and she will more than likely not be reappointed by D.J. Trump. Some of the candidates out of Tyrone Powell, a member of the federal board, somebody named Kevin Walsh, former member John Taylor, a Stanford economist, and of course Cohen himself. So we don't know where that is going to be. This is the same AB Associated Press. Yellen sounds upbeat on the economy, saying likely a rate hike. The reports are a little bit different depending on, well, this is the same one. We had the CNBC report. I'm not sure. Perhaps was that it? We just looked at. Yeah, that was it. It was from the AP there. So basically, the same situation. Let's go to the consumer part of this scenario where we actually get into. This is a survey of consumers at the University of Michigan. For October 2017 is 101.1. That's the index of consumer sentiment. Current economic conditions at 116.4, and the index of consumer expectations at 91.3. So there's a change of 8.2% in consumer expectation. And if we look back to September of 2017, it was at 84.4, and last year in October, it was at 76.8. That's consumer expectations, economic conditions. The change there is 4.2%. The index of consumer sentiment, the change is at 6.3% from Dr. Curtin here. Consumer sentiment surged in early October, reaching its highest level since 2004. The October gain was broadly shared, occurring amongst all ages and income subgroups across all partisan viewpoints. The data indicates a robust outlook for consumer spending that extends the current expansion to at least mid-2018. Which would mark the second longest expansion since the mid-1800s, while the early October surge indicates greater optimism about the future course of the economy. It reflects an unmistakable sense among consumers that economic prospects are now about as good as could be expected. This is as good as it gets. The outlook is supported by moderation in expected pace of growth in both personal finances and the overall economy, accomplished by a growing sense that even with moderation, it would still mean the continuation of good economic times. Although such an outlook is typically recorded in of the last phase of an expansion. Now, that we have to emphasize, the last phase of an expansion, its occurrence is independent of the ultimate length of an expansion. Indeed, nothing in the latest survey indicates that consumers anticipate an economic downturn anytime soon. While contrarians may consider a clear warning sign of trouble ahead, nonetheless, consumers anticipate a low low inflation. There is, let me finish this up. Small increases in interest rates, and most importantly, modest income gains in the year ahead. If this acceptance of lackluster growth rates in personal income and in overall economy that signifies the consumers have accepted, however, reluctantly limits on the pace of improved prospects of a living standard. Now, that does say a lot. On another front, Social Security benefits will increase 2%, and that is due to not specifically economic growth, but inflation generated by the storms in Texas, Harvey and Maria, etc., and nothing else. So we have to understand what is going on here in these flukes. Now, many times flukes can cause other kinds of problems. Won't get as much into that. This is issued by the U.S. Census Bureau. This is the advanced estimate of U.S. retail and food service sales for September. This is issued on the 13th of October. For September, adjusted for seasonal variations, holidays, etc., but not for price changes, we're at $483.9 billion, an increase of 1.6% from the previous month and 4.4% above last year. Total sales from July 2017 to September 2017 were up 3.9% from the same period a year ago. The July 2017 to August 2017 percentage were revised down 0.2% to 0.1%. Retail trade sales were up 1.7% from August of 2017 and up 4.7% from last year. Gasoline stations, now this is where your inflation came in at 11.4 from December of 2016. While building materials, garden equipment, and supply dealers were up 10.7%, of course, due to the storm. October's advance monthly retail sales report will be released on the 15th of November. So it'll take some time to get that out there. And that is all we have there, okay? Now we'll get away from there and we will go, as they say, merrily along here. One of the characters that used to head, a restaurant chain out in California. He was briefly the Treasury Secretary, or the nominee, and he disappeared. Carl Jr. Anyway, this alternative measure of labor underutilization for states, the third quarter of 2016 through the second quarter of 2017. 6 alternative measurements of labor underutilization have been available on a monthly basis for the current population survey of the U.S. as a whole. They are published by the Bureau of Labor Statistics here. And the 6 measurements are the U1, persons unemployed 15 weeks or more, the U2, job losers and persons who complete temporary job programs, U3, total unemployment as a percentage of the civilian labor force, and U4 unemployment plus discouraged workers, and U5 total unemployment plus discouraged workers, and U6 total unemployed plus all marginally attached workers. So this is some of the reports here, and this is by state. And let's see, this is the third quarter through a second quarter here, and these are percentages. We'll just kind of move over these. 1.8 for U1, that is in Alabama. Or it's in the U.S., U.S. as a whole. In Alabama, it's 2.3. Alaska 2.9. These are some of the measurements here. And if we go, persons only employed 15 weeks or longer. And we'll go, say, to California, 2.1% there. District of Columbia, 3.5%. You can sort of see where we're going with this. Number of people. We look at Kansas, a low unemployment rate there normally at 1.2, 2.1 in Kentucky. Louisiana, 2.5. The Commonwealth of Massachusetts, 1.8. 1.5 in Michigan. Michigan's went down. Michigan used to be one of the bigger basket cases. Ohio 2.1, 1.8 in Oklahoma. South Carolina 1.7. South Dakota 0.9. And LA County 2.2 in New York 2.4. Now, if we go over to the total unemployed plus all marginally attached workers plus employed part-time for economic reasons, a percentage, and this is what's called U6. We start looking at the U6 numbers. For the U.S. is 9.2. For Alabama, and this is all your part-times, etc., 9.8. You see these numbers going up. Arizona 13.1. California 10.7. Now again, this is U6 that includes the total unemployed plus all marginally attached workers plus employed part-time for economic reasons as a percentage of the labor force. So you get these numbers much higher. We'll give a couple of more of these. Georgia 9.5. Colorado a lower number, 6.4. We start picking and choosing here. Louisiana 10.4. The number is up there. Massachusetts is 7.6. Michigan 9.5. You can see where these states, if we go like Mississippi 10.4, we expected that. And Nevada 11.5 shows you where the economy is in some of these states. New York 9. North Carolina also 9, much smaller state. North Dakota 9.5, so it tells you a lot of part-time workers, etc. in North Dakota. 9.1 in Pennsylvania. And if we go down to Washington State, 9. That's Virginia 9.7. Washington State 10.1. West Virginia relatively low, 7.2. And for Los Angeles County, 11.1 there. And in New York, 8.9. Not as bad. So I would give that number out here to show the economy is moving, but not perhaps moving as quickly as some would think. Let me find the article here. Here we go. This is from Bloomberg. And let me just start the article out here. You'll hear this is the crash of 87 from the Wall Street players who lived it. Black Monday's fire drill, stakes from DeMonico, cash in the rafters. One guy put some cash in the rafters, and I guess it's still there. He doesn't know where they are. But anyway, this did happen. When things decline a lot, you remember the date. That was the 19th of October, 1987. One example, the biggest single-day stock market collapse in history, 23 points. Rendered the once trusted, our pointer was, we hit the wrong button on our pointer. Ideas useless and redefined the financial landscape for market professionals. One was the rising Salomon Brothers bonds sales type, Michael Lewis, who had yet to pin lies poker. The market in a panic are like countries doing a coup, and it seems in retrospect, that this is how they were that day. He would later write of the chaos he witnessed, small groups of people with old established ways of looking at the world hustled from its seat of power. Black Monday, as the day became known, is part of financial history's fossil record, a divide between old and new markets. It was the first significant instance of computer-driven trading run amok. Nuisance quality option market saw anticipations based on the model overrun, replacement by a more complex world of volatility skews. And the federal chair there, that was Greenspan at the time, just 2 months on the job, got a glimpse of a market panic and sells his first Greenspan put. To mark the day, the 30th anniversary Bloomberg markets asked the players to reflect on it. While everyone remembers the day, 31.5% of IBM declined. At the time, IBM was the big stock, was the benchmark. People felt that if IBM fell, the whole country would. The real black market story is less about the carnage in equities than what happened elsewhere in options, futures, and fixed income. There's also the story of Tuesday with its trading and never fully explained until now. Rally, most people willing to share their memories, they count themselves as winners, who seized the moment of an opportunity not only to make money, but also to insert themselves in the new financial order. Paul Tabor, you'll hear from Tabor Jones, you hear from him. Stanley Druckmiller, here Nicholas Taleb, and their stories here. So some of these stories recounted. We thought we'd look at it, and when we leave, you'll hear a little presentation from that day here with various people. Let's see if we can. We're trying to get him, and it just didn't work out for us. I guess we're not going to get his little deal here, but we'll get it overall. The Fed chief and his staff had basically subverted the hotel switchboard. Well, yeah. So the Dow that day fell 508 points. Roughly 6 million shares were traded. Both were a record. A record at that time. Greenspan landed in Dallas. The story is that when he got off the plane, he asked where the market ended up. The response was 508. Greenspan replied, "Oh, good. It hasn't had a nice rally." He thought it was 508. No, actually. There was some controversy there about what they meant. He didn't quite understand. It was 508 down there, so it was not the greatest day in the behavior of the market. Let's do the numbers now here, and then we'll hear from that little package. Let's see, we can. Here we go. We're going to BBC News here, and UK inflation at its highest since April 2012. The consumer price index in the UK climbed to 3%, a level last reached in April of 2012, up from 2.9 in August. The pickup in inflation rate, the likelihood of an increase in interest rates next month. The same is going with the UK central bank as with the central bank here. The figures are significant because the state pension fund, and this is will rise in line with the CPI. So they'll get, let's see, where will they end up? The CPI rate earning a growth of 2.5%. Under the triple lock guarantee, the basic state pension rises equal to the September CPI. So the September, well, we haven't got to September. We got August. The new state pension equivalent to, let's see, $159.55 per week. These are pounds, equivalent to 8,296, and I guess that's 60 pence pounds. The interest rate, anyway, that would be where they would be going, earning growth of 2.5%, whichever is the greatest. So in other words, 2% in the U.S., 2.5% there. The fall in the pound since last year under the Brexit vote has been one factor behind the rise in inflation. The cost of imported goods. Inflation has hit a 5-year high and is now above 0.9, the rate of wage growth, meaning that the income squeeze is becoming tighter. This is an analysis here. Poor economic growth figures and the uncertainty over Brexit, the Bank of England's decision on whether to raise interest rates next month is finally balanced, according to this analysis. But many believe that inflation may now have peaked as the effects of sterling's depreciation following the referendum. Anyway, interest rates rise, and which includes prices for millions of mortgage holders. So it becomes somewhat of a basket case in the UK. Pensioners will celebrate again. Today's CPI inflation figure means that they will get actually a 3% raise next April, the highest in 6 years. So it was 2.5. Compared to that, workers will see their earnings rise by 2.1 over last year. This is all thanks to triple lock, which sees the state pension rise by its highest earning price, or 2.5. So the 2.5 there is you get 2.5 highest, so they'll get 3%. So that roughly means they'll get pensioners will end up a percentage point higher than there. Now for triple lock is due to drop in 2021, a few years out. Anyway, let's do the numbers now, finally. The BBC Global 30 today at 29.90. The FTSE All Share down a negative 3.002. In Amsterdam, 0.33. In Frankfurt, the DAC at 4.17. In Paris, they are down 1.91 today. In Brussels, 4.41. In Madrid, interesting looking at what's happening in Spain now, at 1.70 there. And in Zurich, they are down a negative 22.15 with Catalina, the breakaway region there in Spain. In Moscow today, 9.57, good for them. Johannesburg all shares on Friday down negative 94.82. In Bombay today, negative 20.86. In Karachi on Monday, 94.61. In Lahore on Friday, a negative 45.11. In Colombo on Monday, a negative 36.36. And in Tehran on Monday, 195.80. In Sydney today, 73.40. The Nikkei is at 0.81. The Hang Seng in Hong Kong today at 4.69. In Shanghai today, a negative 6.43. The Dow on Monday, 85.24, and the Nasdaq at 18.20 on Monday. And the Merck at 4.47. In Sao Paulo on Monday, they were in the red, 1,046.17 negative. In Mexico, also negatives on Friday, negative 648.42 there. Let's get the commodities. Well, gauge where oil is going because of a situation in Iraq around Kirkuk, that is in the Kurdish area there. Those oil fields are recaptured by the Iraqi security forces. This is Brent crude futures at 58.05, up 23 cents is what it amounts to. That was today. And on Wednesday, the spot was also at 58.59, was up 65 cents. West Texas crude, the benchmark here in the U.S., up 24 cents at $52.11. T-Bone Pickett is jumping for joy. He remembers a $15 a barrel oil, which is about where it is today. We'll give it take a few dollars here. Let's see what else is going here. Coffee futures still up $1.20, and $23.75. Cocoa's up 2,044. I'm not sure where all that's coming from. And nonetheless, on the Forex, where's gold? It's up $11.25 at $1,305.16. That was on Monday. And Dubai Gold Futures down $9.80 at $1,296.10 today. Silver on a Monday is up 21 cents at $17.41. On to Unex Life Futures. For some reason we like it. Robusta Coffee Futures up $5. And white sugar futures up $1. The Bloomberg Commodity Index on a Wednesday at 85.59. That is it. $85.59. This will do it for us. On to a recap of what was termed Black Monday in 1987. When Reagan was moving along in October, finishing up and going into election year. But fortunately for him, things did come back, but a much smaller economy. That is one thing to remember. And also at the same time, Reagan's tax cuts, etc., were not the tax cuts of today. So what we'll be looking at is what happens in Congress, and particularly with health care. The Trump administration has unwound many of the features they're trying to of Obamacare, including the old idea of associations selling insurance products across state lines, selling watered down, in our opinion, useless policies that don't take care of pre-existing conditions, the extension of the so-called Fremont temporary or COBRAs, which can be very expensive. For instance, the average one's about $1,000 depending on what kind of plan you have. or more. So that is some instances there. He wants to cover pregnancies, birth control, I should say, and many other things that are now in Obamacare, and also the federal subsidy to the insurance providers themselves. That's about $7 or $8 million out there. So many states will lose out on that, and a bad period because the countdown starts next month in November, and goes roughly a month and a half, basically. November and December, they will end shorter period. Very little PR promotion of it. So we'll wait and see there the income, the impact on the economy, and also what will be of this so-called tax plan. We don't know. We know some broad brushes, but it is all literally up in the air. We'll talk to you next week or when it's necessary. Good day from WBRN Radio and the Bostonred Network. This has been This Week in Economics on the 17th of October, 2017. Good day.
Percentage drops that we saw in 1929. Point-wise, this, of course, is a record as well. Volume-wise, records across the board as we saw the tremendous selling that we experienced last week hit the trading floor once again today. And how? In fact, we show you the chart of the Dow Jones Industrial Average for today. They've had to redraw the chart, and there it is, redrawn with new limits on the Dow. And you can see that near the close there we had a gap down on the close, tremendous amount of selling on the Dow Jones Industrial Average as we finish down about 450 points. I don't have an exact reading in front of me right now, but as you'll be able to follow on the lower ticker there, it is a record drop. All right, let's try and put this in perspective. We're going to go live to the floor of the American Stock Exchange and talk with Paul Tudor Jones of Tudor Investment. We'll also get an update from the action in Chicago. FNN's Ron Insana is standing by there with a guest, floor trader, and then our own John Bollinger will be here to wrap up the program with his own analysis of today's market activity. Though first, let's go to the American Exchange live, where the tremendous amount of selling there as well today, where we have futures trader Paul Tudor Jones, the president of Tudor Investment. Paul, can you hear me okay?
I can hear you, Bill.
Okay.
I'm not sure I want to, but I can.
Yeah, I can imagine, buddy. All right, give it to me straight, Doc. What, in your view, is going on?
I think that we've got a market that has been seriously overvalued for some time. I think that what we've witnessed the past couple of days has obviously been the piercing of this bubble, and I think that what you saw today and what you may see tomorrow morning will be the culmination of this selling climax for now, and I emphasize for now.
Now, you had told me a few weeks ago that you were looking for a drop. Did you expect it to be this precipitous, this quick?
No. We thought the market would be under pressure through October. We thought it'd go to the low 2200s, but we thought you'd see this kind of a break sometime early next year, but quite apparently the market's doing exactly what it always does, and that's fooling 99.9% of the people, and that's why it's happening now. I would say Wall Street uniformly was unprepared for this magnitude of a drop, and of course that's why you got it, because that is the nature of a market.
Yeah. Now, you know, people had been looking for a drop when the bear market set in, perhaps after we had hit 3,600 on the Dow. Is this the kind of a drop where we're going to wash that out, have a bear market that could last a few weeks and then it's over with and we resume the uptrend? What are you thinking?
I think that you are in the beginning of a primary bear market that's going to last for, unfortunately, a long time to come. The action today, if you were a stock trader, and particularly if you were a stock trader trading simply on a technical basis, you would have made two trades in the 80s. You would have bought the market in August of 82 when you had record up volume and you had a record up day on a nominal basis, and you would have sold the market beginning on Friday when you had range expansion, a record nominal down day, and also record volume. Today is simply a confirmation of what began on Friday, and the only thing that I can take heart in is I think that you did unquestionably today finish this wave of the selling climax. I think you've got two things to look forward to in the next 24 hours. One good and one not so good. The one bad thing is that this afternoon, Proctor on his hotline will unequivocally come out, not unequivocally, but I would say the odds are or over 95%, that he'll come out and say that the bull market is over and then we're now beginning a major league bear market. But I think a lot of people, particularly professionals, recognize that fact, and that was certainly discounted to a great extent today. The second thing that we have to look forward to in the next 24 hours, and certainly we better see this, is we should see massive federal and governmental and administrative intervention in foreign exchange markets. We should see them in the debt markets. We should certainly see some type of constructive action to stem what has unquestionably been a panic. And I think that you'll see the market on the cash side start out weaker in the morning, but I would, my gut instinct tells me that you'll finish up on the day tomorrow. I think the prudent thing for investors to do at this point is unquestionably not to buy, is to look for some type of a rally later this week, later this month, whatever. And I think the thing to do is to prudently scale back and move into some type of short-term treasury instrument, whether it be notes or bills or something of that nature.
What are you as a professional trader doing with this market, Paul? Are you just out of this, or are you trying to trade this at all? I mean, I know you're the maniacal trader anyway, huh? Sitting in front of the Quotron machine all day. Are you trying to play this down move at all?
We've traded it heavily for the past 2 weeks, and that's the only comment that I'll make.
Now, as far as the rest of the futures markets, is there any kind of a play there? I mean, gold went higher today. Oil kind of went higher at one point, but are you looking at those as trades right now?
I think that what you've got going on, for instance, if you notice today, you had the CRB index down, yet gold and silver were through the roof. You know, one of my favorite trades right now is unfortunately being long fear, which means being long the metals complex and short the rest of the hard commodity complex. Because I think what you're going to see over the course of the next weeks is you're going to see, and of course what you saw today was the fear of a liquidity crunch and the fear of disinflation and not deflation, disinflation and deflation.
Yes.
Gold and silver were not up today because of inflationary fears by any stretch of the imagination. They were up because of the fear factor.
30 seconds. Are you afraid for the economy at this point? I'm not trying to, make this reactionary at this time, but is that something that we might consider as well?
I think that every American at this stage of the game needs to get their house in order, needs to be prudent and be conservative in their investments, needs to cut back on whatever speculative investments they have. I think the next few years will be a period of capital preservation, and that's where the emphasis needs to be.
All right. Thank you, Paul Tudor Jones, very much.
You're welcome.
Paul Tudor Jones of the Tudor Investment Corporation, standing by there live at the floor of the the American Stock Exchange. The New York Stock Exchange tape was delayed 2 hours, 10 minutes at the closing bell. The transactions you see going by there are that late. However, I will point out that the lower ticker that shows you the real-time FNN summary quotes are actually up to date at this time. We will continue. We're going to go to Chicago when we come back and find out what's going on there as well. Stay with us.